Hey everyone, in today's video, we're going to be going over 3 new stocks that I bought for the first time in my portfolio in this last week. Each of these stocks I just bought a very small position into, looking to average down over time, but still wanted to share the stocks with you, the valuation, some reasons why I bought each of these stocks. But before getting into this, if you like this type of content, be sure to subscribe to the channel and also give this video a thumbs up. The likes on this video really do help a ton with the YouTube algorithm, get these videos out to more people. So if you just take a minute and give the video the thumbs up, we'll get right into it. Okay, so the first stock here today that I bought this week for the first time is Wyndham Hotels and Resorts. Wyndham I bought at $65 yesterday. This company is one that's been on my watch list for a very long time. Looking at this company over the last year, it's down about 14%. Longer term, you can kind of see the volatility on this stock. It's jumped over $80 a handful of times. Currently on a bit of a dip here, trading at about $5.6 billion market cap. They're making about $4 of earnings per share this year. So this is about 16 and a half times earnings that I bought the company. They do pay a nice little 2% dividend yield as well. Getting into the company a bit more. So this company owns all of the trademarks you see on the screen. They play primarily on the economy mid-scale side of the hotel market. That's where the predominant amount of their income comes from. But they've been trying to diversify into mid-scale and upscale in the last few years. They do not actually own any of the hotels under these branches. They're all franchised, so it's all individual businesses or different holding companies that own a bunch of them. They just get paid a royalty on every dollar that each of these brands bring in. So it's a very capital light business model. They just get royalty income coming in, some marketing dollars and development dollars going out, and the rest goes straight to shareholders for dividends and share buyback. So really efficient business model. That's one of the things I like the most about this company. Going into their recent performance, so they just reported earnings and they're doing pretty well. They grew their RevPAR by 12%. In the US was a bit less than that at 4%. They signed new deals to get incremental rooms, whether that's acquiring existing mom and pop hotels to use one of their brands or developing hotels and selling them to new franchisees. So their room growth went up 4%. And lots of their growth, when you look from United States and international, lots of their growth came from their international division. So they're really diversifying their business a lot more over the last quarter and the last year, which I really like to see as well. Lastly, on Wyndham, you can kind of see here their share count over the last 5 years. I think they've only been public in this way for 5 years. They launched with 100 million shares. They're down to 85 million. So they've bought back 15% of the company over the last 5 years, about 3% a year on average. This is a byproduct of just having a very asset-light business model. They primarily get straight royalty income. They don't have many expenses. So they end up having about $500 million in free cash flow. They give some back to shareholders in dividends, but the rest of it, they either come up with new brands, like they are right now with a long stay brand called Echo that they're starting to build out a bit. But the rest of it, they just return to shareholders through dividends and buybacks. So they've been buying back a lot of the company. They'll continue to do that, especially if it is at relatively reasonable valuation. So I love continuing to own more and more in the company every quarter from here on out as they allocate capital that way. So overall, trying to keep this one pretty quick, but this is a company that I love their capital allocation model, returning lots of money to shareholders. I think obviously volatile in nature given the industry that they're in, but long term, I think travel and hotels aren't really going anywhere, so I feel safe about that. And I think it's at a reasonable valuation, about 16 times. Sure, if we go into a deep recession or something, I acknowledge the stock will go down. I'll average down in that case, build a bigger position out. But this is one that I feel comfortable with. Love the royalty business model. I own lots of royalty-esque type stocks. So looking forward to hopefully building this into a bigger position. Going into stock number 2. Stock number 2 is Topgolf Callaway. This is another one that's been on my watch list for a while. I bought it at big update today, but I bought it at about 17.50. In the last week, let's call it, the stock's gone off of a cliff after their earnings report. They lowered their operating income guidance, which investors clearly did not like, traded the stock down huge. The stock's currently trading at about a $3.5 billion market cap, I believe today. They have about 200 million shares outstanding, and they're anticipated to do about 4.5 billion in revenue this year. So profit's a bit murky because they're spending a ton on capital expenditures to build out more and more Topgolfs and things like that. But if they can just have like a net income of 10% on their current business once everything's stabilized, they'd be trading at like 7.5 times earnings. So overall, I think the revenue multiple on this one of under 1 is attractive given the growth profile of Topgolf, and Callaway is just a cash cow in general. So we're going to look at this business a bit more in depth. First of all, just summarizing their 3 segments, you got Topgolf, which is really the main focus of the company now. You have golf equipment, which includes Callaway, Odyssey, some other golf apparel brands. But Callaway is really their biggest one. They're the number 1 golf ball in the world. They have about a 20 to 22% market share of golf balls. Number 1 driver, number 1 wood, number 1 fairway. So lots of traction, lots of stuff going on the golf equipment business. And then to diversify a bit away from golf, but still in the lifestyle realm, they own a lot of active apparel brands. So Travis Matthews is one of their flagship brands. They also own Jack Wolfskin, OGIO, probably pronouncing that wrong, but they've expanded Travis Matthews really well globally. Really strong revenue and profit growth on that business. All in all, I'd say the vast majority of the focus and the reason for owning this company is Topgolf. They're operating, I think like 70 or 80 of them. They're opening one new one a month pretty much. They opened 11 last year. They're opening 11 more this year. And the business model on Topgolf Callaway, on Topgolf rather, is very strong in terms of the unit economics. They're getting cash on cash returns of about 50%. Estimated payback periods for their venues are only about 2.5 years. You kind of see the cost to go into them are somewhere between $20 and $40 million, depending on the size. And their EBITDA margins are about 35%. So we're getting overall, without leverage, return on investments of 20%, give or take, which is really strong. And I feel like with some of the leverage they take on, you're going to get closer to the 30-40% return on investments. So a great allocation of the free cash flow of the other segments. And I don't mind the company having murky profitability as they invest more and more in building out more Topgolfs in their ecosystem and technology across the Topgolfs. Going into their outlook for the year, so you'll see the guidance is about $4.4 billion. Once again, the market cap of the company is about $3.5 billion. So they're trading at about a 0.75 times revenue multiple, despite the growth that Topgolf still has to come. Adjusted EBITDA at $600 million, so trading around 6 times EBITDA. And then they do have a good amount of debt. So that's behind lots of the investments that they're making in the business and what they took on with Topgolf when they acquired Topgolf. But they did mention on the last call they're going to try to bid that down closer to 3 times EBITDA, down from 4 times where it is currently. So hopefully that we'll see that number go down closer to $2 billion. And with the revenue growth on the overall business, while it's a bit risky given that debt level and interest rates where they are, I think they'll be able to manage that with time. Going into just some of their highlights from the last quarter. So from a same venues, from a same venue sales growth perspective on Topgolf, they grew 11%. That's really strong, especially given they opened up more Topgolf. So there's more of them out there, but each one of them is still doing more in sales versus a year ago. And that's the 6th consecutive quarter of same venue sales. The profitability versus the expectations continue to get better and improve, which is great since Topgolf is really the future of this company. And then they remain on track on their cash flow positive guide by the end of the year. So even with all this capex, they're still expecting to be cash flow positive. Just imagine how much more cash flow positive they're going to be once they're not opening up a full Topgolf every month, which costs like $20 to $40 million. So huge amounts of money being invested there. Overall, I think Topgolf is a bit more speculative than something like Wyndham, just because it's focused on discretionary spending. In addition to that, you're kind of counting on the construction and the continued traction of Topgolf to pan out, be a sensation across the U.S., hopefully in other markets around the globe that they open in. But I think the risk reward on this one is great, trading under 1x revenue, with revenue growing at the pace it's growing at, and the underlying unit economics of Topgolf. So that's why I'm starting to make a bet on this one. We'll see where the stock price goes. If it goes down, we'd love to average down more. If it goes up, we'll gauge the value there. This one's really gone nowhere over the last 5 years. Up and down a bit. You can kind of see it traded in the mid to high 20s for a while, back up to the mid 20s, currently at 18. So I just thought it was a good opportunity. If I was going to play this stock, get some exposure to it, this would be a good time to do it. Going into stock number 3. Stock number 3 is a Canadian company. It's Labrador Iron Ore Royalty Corporation. This company produces iron ore on the east side of Canada. They export it everywhere in the world, China, you name it. And iron ore is essentially a input to construction. So whenever people are building bridges or big buildings or whatever it may be, they need iron ore to help them make the raw materials for that construction. This holding company owns 15% of the underlying mine, but then also gets a 7% royalty on every ton that leaves the mine. So really interesting business model, cash flow heavy, not a lot of debt or anything like that on the balance sheet. The company's overall value is about $2 billion, and it says it has a 6.7% dividend yield, but the dividend really changes every quarter. In some periods, this company has yielded 20% a year in an environment where the cost of iron ore is going up. In others, it's traded as low as 5-6%. So it really just depends on the macroeconomics. Kind of get a sense here, as I just said, 15% equity in the Iron Ore Company of Canada, 7% top line royalty, and then 10 cents per ton on all IOC sales. I guess that's in addition to just iron ore. Going into some of the pricing of the cost of the raw material, you can just see how volatile this is. It went down to $50 in 2016, up to $300 during COVID. So that's a 6x multiplier. Since then, in some areas, went all the way down another 50% to about $150, give or take. So you're really buying the underlying commodity here, and it does come with a lot of volatility behind that. But when you look at the distributions, you can kind of see in 2021, they paid out $6 in cash flow. So on the current share price, that's a 15% plus dividend return. In 2022, it looks like they're on track to pay over $3. So once again, that's about a 10% dividend. So this one is just completely a byproduct of the amount of iron ore that gets cranked out of this company, as well as what the current price of iron ore is. You can kind of see down here, longer term, over the last 10 years, the company's annualized returns of 12%, 5 years, 20%, 3 years, they had that crazy year during COVID. So last 3 years, it's 32%. But acknowledge that this is it's essentially a hedge on commodities and the global economy for me in a high cash flow manner. If this stock went down big, that would be something I'd be willing to live with. Still a very, very small position, just have a handful of shares. If it goes down, would maybe buy it up a bit more, but I like the diversification and getting that big quarterly dividend check. So that's the reason I bought some Labrador Iron Ore Royalty Corp. And yeah, these are the 3 new companies that I've bought in the last week. Would love to hear your thoughts on any of these 3 companies below. Tried to make this video a bit quicker than some of my other ones. So let me know if you made it all the way to the end in the comments. Not too many people do, so I really appreciate you. If you like this type of content, be sure to subscribe to the channel, like the video for more. Liking the video really does help with the YouTube algorithm, and I'll see you guys in the next one.